Okay, welcome everyone. My name is Musungiri Tongwe. My friends and family call me Susu. I hope you guys are having a fantastic week. Who I am a software engineer based in the Dallas Fort Worth Metroplex. I have a real passion for real estate syndication. I believe real estate syndication is what's going to change my life and replace my income. My intended audience for these videos that I look to pump out weekly are for uh, general partners, limited partners in the business of real estate, multifamily deals, and just anyone that has a general interest for underwriting for multi-million dollar real estate deals. Without further ado, I'll get right into it. So here, I have a underwriting that I did for a property I cannot disclose because um, because of confidentiality agreements that I accepted. I may omit some things, but I'll try and keep the numbers as transparent as I can. The apartment property, this multifamily property, it has a total of 384 units. It's a classy property built in 1971. Our loan term years are 30 years. It has an anticipated IRR of 15.1%. This underwriting considers a investor split of 80-20, no preferred returns, a property management fee of 3% and an asset management fee of 1%. Um, by the by the end of exit, which I like to look at 5 years, maybe 7. Um, the investors will receive a total return on their capital for 5%, which we'll break down and get more into, so you can really see the numbers. So regardless of if you're looking at the list price or what may have you, um, money is made at the acquisition. So just because it's listed for however many much, the deal has to make sense. So you want to pick a purchase price where the deal makes sense, the numbers make sense. So moving forward, we're going to move on to our input sheets. Just reiterate some things already mentioned. Asset management fee 1%, property management fee 3%. Our syndication metrics, which is our split, we have an investor split of 80% and a syndicator split of 20%, with a syndication fee of 3%. All a syndication fee is what is paid out at closing for putting this deal together. So at closing, the syndicator receives a one-time fee that is 3% of the purchase price via the offering memorandum, which is basically just a brochure, giving information about the financial analysis on the property. They mentioned they have a vacancy rate for this property of 10%, meaning that the property is currently 90% occupied, right? Now, what I like to do with my underwriting is I like to scrutinize these numbers because I want to know worst case scenario, uh, what can we earn if we acquire this property? So what I did was I subtracted an additional 5% from this vacancy factor year one of acquisition. Um, Now, between year 2 and 10, we anticipate the property will begin to stabilize at a 5% vacancy rate. Moving forward, whenever you're trying to underwrite property, you want to get two things from the seller. You want to get the T12. The second thing when you have the T12 is the rent roll. The rent roll is who is currently occupying units and what units are currently vacant. So looking at the gross scheduled income for the column current here, this $5.4 million dollars, I don't like it because they baked in the loss to lease um, into the gross scheduled income. And to be honest, the T12 that I received for this property was pretty shot. But after doing my diligence with the current T12, they had a effective growth revenue of roughly $6.2 million right here. We'll come back to this year one manual adjustment. They had operating expenses. Their total expenses was roughly $2.5 million, giving a current NOI of about $3.6 million. Here in this column for our year one adjustment, there's a 3% growth because we're anticipating a 3% growth for inflation. Continuing to move forward, we have the rent roll, and if I come over to here, this here in this area is the actual rent roll. I won't show you the entire rent roll because of the confidential agreement that I agreed to. Here on this side is what is called a pivot table. Basically, this pivot table represents all the information gathered from the rent roll as far as numbers, right? So we have a column for occupancy, we have a column for type, we have a column for the count of each type, we have a column for average market rents, we have another column for average of the actual rents, and we have a sum of the actual rents, right? So for our types of units, we have studio apartments. This zero represents 0 bedrooms, 1 bath. We have 1 bedroom, 1 bath. We have 2 bedrooms, 2 bath. 3 bedrooms, 2 bath, and we have 2 vacant 1 bedroom, 1 bath, and we have 31 vacant 2 bedrooms, 2 bathrooms. Right? The average market rents for a studio apartment is $995. The average actual rents for a studio apartment for this property is $930, right? Now, if you take $930 and multiply it times the amount of studio apartments, you get a sum of rent $17.6 thousand. So what this means is every month there are 19 occupied units. Every month you receive $17.6 thousand for those occupied units. And this same formula can be followed down the line. The sum of rents you receive every month for your occupied units are $474,000 roughly. If you take that number and you multiply it times 12, roughly, $5.7 million a year that you earn in gross income. Now, this $5.6 million is, it's close to, what they currently make. The only difference is with our number, we're not able to calculate loss to lease because they baked it into their current gross scheduled income, but it's relatively pretty close. But with these numbers, you're going to actually go to a property manager and you're going to say, hey, Mr. Property Manager, right now on average for my studio apartments, we receive $930, right? Now, after acquiring this property, year one of ownership, you say, Mr. Property Manager or Mrs. Property Manager, can we raise rents, without renovating anything? Can we raise rents, from $930 to an average of $950? The property manager might say, "Oh yes, Sue, of course we can do that." And so you would go back and say, "Hey, Mrs. Property Manager, we're receiving $1,130 on average for our 1 bedroom, 1 bathroom units. Can we raise it $5 more without renovating anything?" property manager might say, "Oh yeah, yeah, that's definitely doable, right?" And you would just go down the line with your property manager, figure out what might you be able to raise rents to. Now, I didn't raise these rents by much. Again, I mentioned before, I scrutinize all of my numbers to really get a good picture on what I'm looking at, as I'm underwriting a property. So if our average actual rents for a two-bedroom, two-bathroom unit is $1,387, I'm asking my property manager, without renovating a single thing, can we raise rents an additional $3? Average rent, actual rent for my three-bed, two-bathroom units is $1,648. I'm asking my property manager, can we raise rent an additional $2? Of course, like that's not a big deal without renovations. Um, we also want to consider our vacant units, right? So we have two vacant, one bedroom, one bathroom, and it's the same pattern. If on average we're getting 1,130 dollars on average for a one bedroom, one bathroom unit, can we receive $1,135, right? Same thing for our vacant two bedroom, two bathroom. Can we raise an additional $3, right? So at 100% occupancy, right? At 100% occupancy, um, for year one, what is our potential gross income? Every month, with our year one target for a studio apartment at $950, every month for this at 100% occupancy, we can expect to earn roughly $18,000 year one. $18,000 a month for a studio apartment. And it's the same pattern going down the line, you know. If you multiply $950 times the number of units, 19, you get 18,000. You take 1,135, you multiply it times 95, you get roughly $107,000 a month for your one bed, one bath units, right? It's the same thing going down, and we're actually considering, because we're considering 100% occupancy rate, we have to include our vacant units, right? So every month at 100% occupancy, considering our rates for rent, we will receive $521,000 roughly a month, right? And then we would take this number and multiply it times 12, because there are 12 months in a year, and we will get a total gross year one um, amount of, $6.2 million roughly, right? So we go back to our T12. I mentioned I was going to come back to this column here, this year one manual adjustment. That's the same number you see for our gross scheduled income, right? The reason why there's such a big jump between 5.4 million and 6.2 million is because they already baked in their loss to lease, and we just don't know, like, the calculation. We just see a number. We don't know how they got there, right? But for our year one manual adjustment, our first year of ownership for this property, we have $6.2 million. We're going to subtract 1% of this amount to loss to lease. If a unit can rent for 1,000, but I'm only getting 900, I'm losing $100, right? Loss to lease. That's what that means. So this $6.2 million minus this $62,000 loss to lease will give us this amount of $6.1 million. It's still roughly $6.2 million. And then this less vacancy, right? I mentioned that our year one, we're going to scrutinize this this 10% vacancy factor and subtract another 5%. So now we're at a vacancy factor of 15%, meaning that this property is operating at 85% occupancy. If we're subtracting 15% from 100% occupancy, we will lose roughly $930,000, right? That's what this number means. You know, subtracting our gross potential income, right, which is roughly $6.2 million, and we subtract 930,000, we get a total rental income of $5.2 million roughly. Now this $5.2 million gets an addition to it because of our other incomes, right? Our utility incomes, right? And so this number right here is adjusted for inflation. So how we got to $206,000 is we multiplied the current income by an additional 3%. And we did that for the utility income. So that's how we got this number, giving us an effective gross revenue year one, $6.6 million. So to continue, returning back to our rent roll and our year one target, we know that our year one target is $6.2 million, right? So now looking at our year four target, right? It's been we've owned this property for 4 years now. We want to know what we want to get a ballpark of what we could be making year four, right? At 100% occupancy. So you go back to Mr. or Mrs. Property Manager year four, and you say, hey, it's been 4 years. Year one, average market rents was 995, right? It's been 4 years now that we should definitely be making more money than that. So you go back to Mr. Mrs. Seller, Mr. Mrs. Property Manager. You say, hey, what can we get for rents now for our studio apartments? Now these numbers here are just they're arbitrary. I try to keep it realistic, but it is scrutinized, right? So you say, or Mr. and Mrs. Property Manager comes back and say, hey Sue, year one market rent was $995. Here after 4 years, you can really get $1,030 for the same unit, right? Now, over 4 years, we're going to be renovating, units, to fetch a higher rate for them, right? So our year four target, we know that we can make on average $1,030 for our studio apartments. Year four, for our 1 bedroom, 1 bathroom units, we can make $1,215, right? So that's like roughly $45 increase after 4 years to the rents. For our 2 bedroom, 2 bathroom units, 4 years ago, market rents was $1,450. And now after 4 years, we're only considering a $20 increase, right? So these numbers are not huge. We have 1,720. We have an additional $10 after 4 years of ownership. We have $1,170. $1,215, right? So at 100% occupancy, if we were to rent out all of our units For our studio apartment, um, for our studio apartment, we have 19 of them, renting at $1,030. Every month, we're going to receive roughly 19.5K, right? We have 95 two-bed, two-bathroom units. You multiply that times the average rents that we collect, 1,215. We get 115K roughly, right? And it goes down the line like this. The total amount that you receive every month at 100% occupancy is $552,000 roughly. You multiply this number times 12, right? You make a gross income of $6.6 million, right? Um, so so $6.6 million year four, and we had $6.2 million year one. So the additions in rent that we earned over a span of 4 years is $368,000 roughly, right? Now, so if you divide this number by 4 years, the 4 years we had in ownership, basically every year we're making 92,000 more dollars. This information right here is just renovation costs, a rough estimate, ballpark figure of what it's going to cost to renovate each one of these units throughout the 4 years, right? So a studio apartment um, might take $3,000 in renovation costs. So for the two bedrooms, two bathrooms, you have 188 units in total, right? You have 31 that are vacant, and you have 157 that are occupied. Together, that's 180 units. At a renovation cost of 7,000 per unit, you're going to spend $1.3 million renovating all of these units. Same thing for the 3 bed 2 bath. You have 80 units of them at an average cost of $9,000 a renovation cost per unit. You're going to spend roughly $720,000, right? You add all of these up, your total renovation cost is going to be a grand total of roughly $2.5 million, ballpark figure. So now, with all this information considered, I want to remind you that if I did not mention already, the sale price for this particular property that I can't disclose the name to, um, they have a sale price of $46 million. Um, Now, some other details to consider: they have a loan assumption with a balance of $36.4 million at a 5.5% cap rate. A loan assumption basically might benefit one who is trying to get like a lower interest rate um, than what's available today. Interest rates are high, anywhere between 7-8%, right? So the loan assumption is like you take on the responsibility of this seller's loan, and you can benefit a 5.5% interest rate by doing so. Um, I will say, if you can find a deal at a interest rate of today's market and make the deal work, then when interest rate actually come down in the long term, you're going to be making even more money. If you refinance or anything like that. So moving forward, we do have the necessary information now to look at the pro forma, right? Before we get to the pro forma, we're going to take a look at the financial terms. Um, for a $46 million purchase price, you have a primary loan of $34 million. This is really miscellaneous information. I don't want to spend too much time talking about it, but I will say that this is there are no interest only years. It's just there are 0 interest only years when it comes to the payment. That's would like to mention. We come to closing costs. We have our our financing and lending fees. Attorney legals. All this stuff costs money to close a deal. We have escrow account. All of this, is being raised. Uh, we're raising this money to close on this property. So the equity down we would have to put on a $46 million purchase price is, excuse me, $11.5 million, and we have a renovation cost of 2.6 million, almost 2.7 million. Where we got the renovation cost, right? Was from this number here. Our renovation cost to renovate all of our units, right? That number is here, unit renovations, and then we have like a miscellaneous, renovation buffer. Now, what you really want to do is you really want to talk to the seller, and you want to actually get a itemized breakdown of several items. These items can be from boilerplates. I mean, not boilerplates, but boilers, carports, fencing, HVAC. What's the condition of the roof? You want to make notes. So you really want to do more due diligence than just coming up with like a number. You really want to talk to someone to get like a real accurate renovation cost. So now we're ready to look at the pro forma, and we're going to start at the top. So our current T12, we have that gross scheduled income of $5.4 million, right? Um, and then we have our other incomes with an effective growth income of $6.2 million. This number we've seen before, right? We have our expenses down here, right? Right. So now what we also want to consider is like the property management and asset management. They didn't include that inside the T12 that I received. Again, the T12 that I received was shot. Wasn't very thorough in my opinion. But we're left with with a total operating expense of roughly $2.5 million, leaving us with a net operating income of $3.6 million. Now the expense to income ratio is roughly 41%. Rule of thumb, properties are classed in three categories. You have Class A, Class B, Class C. Class A being turnkey property, probably new development, right? Built in 2024, 2023, maybe even as far back as 2020, right? So those are the best of the best properties. They usually are not so expensive to their expenses aren't really so much, right? Hence why their expense to income ratio is anywhere between 25 to 35%. And then as you go further into the alphabets, Class B, following the same suit. Class B properties, they're good, but they're not excellent, right? And rule of thumb is their expense to income ratio can be anywhere between 35 to 45%. And you have Class C, which is like, a property like what we're dealing with, built in 1971, right? Their expense to income ratio can roughly be between 45 to 60%. So our expense to ratio right now being considered is on the low end, right? It's on the low end, not even in range of 45 to 60. I'm not too sure what the seller is doing in house as far as his expenses. but that's the number that he got, right? Um, Considering the offering memorandum, they mentioned that this property is at a 8% cap rate. Um, what a cap rate is a rate of return, pretty much your income divided by market value. Um, by income, your net operating income divided by the market value of the property, and they said it was an 8% cap rate. Um, Further down, we have our financing. Um, we have our financing expenses, which is going to come in handy. So now let's take a look at and considering uh, investors cash on cash. We'll get to that in a moment. So year one of acquisition, operating at a vacancy factor of 15%. Um, our growth income is the $2.6 million that we mentioned. Um, this premium on plant improvements, over the span of 4 years. Um, Over the span of 4 years, we're going to be renovating units, and each year we renovate the units, we can expect to receive an additional $92,000. We got this $92,000. Remember, uh, here, our additions in rents divided by four is this 92, and that's what we're seeing right here. Our loss to lease is 62. Remember this number. We saw this before on our T12, our 1% loss to lease vacancy. Moving further down, um, we have our less vacancy. This number right here is our gross potential income multiplied by our vacancy factor, right? Our vacancy factor of 15%, and uh, this this is how we get this number. So subtracting our growth potential income, or subtracting our less vacancy from our growth potential income, we get a total rental income of $5.3 million roughly, plus our other income, right? This amount we've seen before. This is our adjusted inflation income by 3%, and our utility income adjusted um, for inflation by 3%, leaves us with an effective gross income of $6.1 million. Um, here are our ex here are our operating expenses, totaling up to a total operating expense of 2.8 million, roughly $2.9 million. If you subtract the total operating expenses from um, the effective gross income, we get a NOI year one for $3.2 million. From here, we can see that our expenses to income ratio is 47.5%. Um, and the year one, this apartment would be considered $40 million at evaluation. Uh, Now, you may wonder, okay, 45 million to 40 million. Remember that this number is bigger because the current T12 is operating at a 90% occupancy rate, and we are scrutinizing our our occupancy rate, you know, to be 85%, right? We have cash reserves. This is our financing expenses that we're now getting into. We have capital reserves totaling $96,000. So that's $250 per unit. Our debt service, we have 0 years of interest only. Um, so we can expect to pay $2.7 million a year in debt service, uh, giving us a debt service coverage ratio of 1.16. Now, banks, they like to see a coverage ratio of greater than 1.2. But the reason why this number is so low is because of the purchase price. We're getting this property at 46 million. So net income after debt services, we have a net income year one of $352,000, roughly $353,000. Um, so we would take this number, this net income after our debt service, and then we take this number and we split this number between the general partners and the limited partners, basically the investors and yourself. So you yourself, you're going to receive 20% of this amount, and investors are going to receive 80% of this amount. The investors' cash on cash would be 1.7%. And this number jumps to 5.5 because year one we're doing a lot of heavy lifting. Considering that this year one we're factoring in a vacancy rate of 15%, so that and in year two we're factoring a vacancy rate of 5%. So we're hoping that through renovations of units, marketing, and those types of things. We're really going from a 90% occupancy rate to a 95. Uh, so, because we're scrutinizing our numbers year one with a 15% vacancy rate compared to the 10% actual vacancy rate of the current property as it stands. um, you know that vacancy rate from 15% to 5% is really just a jump from 90% to 95% occupancy. Now these numbers are pretty low. I as a syndicator would like to give investors um, a cash on cash return anywhere between 8% to 12%. And I'm going to show you why money is made during the acquisition of the property. So we go to our financing terms at a purchase price of $46 million, right? Let's see what kind of returns we make if we get if we get our offer accepted at 40 million. Going back to the pro forma, um, we can now see that 1.7% has now jumped to 3.8, right? Um, and it trends up, throughout the years because of, we're adding value to the property. This property is actually a value add opportunity, being that it's a Class C. So instead of the 1.7% that we're seeing at a $46 million purchase price, if you were to buy this same property at 40 million, you're going to make your investors happier than they would have been at 46 million. So with that being said, year two, 8.1%, year three, 9.2, and then we get to the double digits returns. And this is after year one, we stabilized. We stabilized our income. So typically I would consider a exit year, right? So after ownership of this property, what year are you going to look to sell, right? So I would say, um, let's say if we exit this property at 5 years, we have a valuation at exit for $56 million, right? So we sell the property for $56 million and some change. We have a debt payoff, right? We've only owned the property for X amount of time. We still have a loan to pay back to the bank. That loan to pay back to the bank is $28 million roughly. We paid $28 million to the bank. Now we have a rough net proceeds of $28.5 million. Now, because we sold the property, we have to pay investors back their cash in acquisition, right? And if we go to closing cost, we can see we raised roughly $15 million from investors to close this deal. And that's the same number you see right here, investors' equity return. So from the $28.5 million in net proceeds, we're going to subtract roughly $15 million to pay investors back their money, leaving a net profit of $13.6 million. Now this net profit is going to get split again, 80% to investors, 20% to us. So by the time we sell this deal, to whoever's next, investors are going to receive another 10 million. They're going to net $10.8 million from the sale, and we as the syndicators or sponsors, we receive $2.7 million. Over all the years we own the property, investors have received cash flow, and they received a net profit split. Altogether, investors are going to walk away from this deal with $17.2 million. And the total investor cash on cash return is 115% at a $40 million purchase price, right? So we go back to our financing term and take a look at this number at $46 million, which is the sale price by the seller. You can see how these numbers change. So instead of 10 million, investors are going to get 6 million. Instead of the 2.7 million that sponsors receive, we will only receive 1.5 million after 5 years. The total investor cash on cash return drops from 115% to 65%, with a 5-year IRR of 13.2%. Now, there are two ways to exit a deal. You can sell the property or you can refinance the property, which I particularly would 9 times out of 10 rather do, because once you refinance the property, you pay investors back their money and you keep the property 100%. So now we can take a look at what that looked like at a $40 million purchase price. So we're going to go back to our purchase price. We're going to change the 6 to a 0 for 40 million. For 40 million, go back to the pro forma. We're back at our 17 million. So how refinancing work is standard to receive 80% loan to value for a refinance. So what that is you're going to take 80% of the value of the property, right? You're going to take 80% of the value of the property, and that's where you're going to start from. So just how we started at a straight sale of $56 million, instead of $56 million subtracting the debt payoff, subtracting investor equity, you're now starting at $45 million because you're receiving only 80% of this $56 million value. And we can take a look at um, uh, investor returns with a refinance. So at $45 million, um, you're still going to have a net. You're still going to have a debt payoff to the bank at the same $28.2 million, right? The only difference is it's 45 minus 28, and so we get this 17 here, right? This 17 is the rough net proceeds um, in a refinance situation. Uh, so from this $17 million, you're still going to have to pay investors back their equity, which is $15 million. So after you pay investors back $15 million of their equity return, your net profit for this, um, your net profit for this property during the refinance is $2.2 million. You're going to take this $2.2 million, and you're going to split this 80-20 again, right? So investors are going to receive an 80% split for $1.8 million, and you, as the sponsor, are going to receive a 20% split for roughly $450,000. Investors total the total investor return over all 5 years, right? 5 years when we exit, is now going to go from 17 million to 8 million, and they're going to receive a total cash on cash return of 54%. Um, and investor return per year is 1.6 million at a 5-year IRR of 10.9%. Um, Now, typically in a sale, a straight up sale, not refinance, I would love for my investors to receive at least a 20% IRR. But considering this is a refinance and you're working with less money, um, investors are going to get 10.9%, which is still, pretty good for what it is. But with that being said, after 5 years, after year five, when you refinance, you now own the property outright. So you own the property. Well, you don't own the property outright. You just don't have investors that you're splitting with. So now 100% of the proceeds go to you and whoever partners you have in the deal. So instead of investors getting the 80% split, you and your partners now will receive $2.1 million a year, year six, and that goes to you. This is after the operating expenses. This is after the debt service, right? And this is what you own going into however many years you keep the property, man. So 6 years, 7 years, 8 years. Year six you earn 2.1 million. Year seven, you and your partners you earn $2.3 million. Year eight, you earn $2.4 million. Over the next 3 years, you guys own the property 100%. You're going to receive well over $7 million. And you can own this property for as long as you want. Some people they don't sell their property till about year 35 or whatever. And this is just one deal, right? And it goes back to why I say real estate syndication is what I believe is going to change my life. Um, you know, for most of us, it only is going to take one deal to replace your income, right? And if if you just remember that the money is made during the acquisition of the property, you won't lose. I mean, sure, the seller might reject your offer because it's too low or whatever reason, but it's as a buyer, it's always about buying right. So that's all I have for you guys. Um, if you learned something or there was anything that you was able to take away, that's what it's all about. I do plan on, pumping these videos out on a weekly basis. Feel free to reach out to me for any questions. I really enjoy doing this, and I'm passionate about underwriting. Uh, so thank you guys. You stayed to the end of the video. Leave some comments, and thank you so much.